right?
Yes.
The annual fixed operating costs, excluding depreciation, are estimated to be 100,000.
Yeah.
Investment in this asset is expected to cause increase in sale. To support
Yeah.
this increase in sale, the company will require additional working capital. Stock will increase by 100, debtors reduced by 20, and creditors will increase by 30,000. The increase in working capital will be required at the start of the asset. So now you can see this one. This is now working capital, which was not there in the first question.
Yeah.
And you can see this working capital is for year one.
Yeah.
So it will be treated, it's year zero, sorry, when you are making the investment. So this will now be treated as part of the
Out.
initial cost.
Yeah.
Then installation cost of machine is estimated at 100. Freight charges and import duty are estimated to be 100 and 200. The firm provides depreciation on straight line basis. Cost of capital is 12. Corporation tax rate is 30%.
Yeah.
Determine the values of the relevant cash flows which are associated with this capital project. So here now they are not asking about the NPV or IRR, but they are just
Yeah.
telling you to determine the cash flow.
Yeah.
So the initial cost will be the cost of the machine plus this incidental cost of installation, freight, and import duty. So
Yeah.
if we were in accounting, this will
Yes.
be the historical cost of the machine.
Sure.
But what we need is the initial cash flow.
Yeah.
So you need now increase in stock. You add debtors, any decrease. Remember, these are assets.
Yeah.
If you have a decrease, you deduct.
Yeah.
Creditors is a liability.
Yes.
So if we have creditors decreasing, you add.
Yeah.
If you have creditors increasing, you deduct.
Yeah.
So this will give you a net working capital of 50. That is 100 minus 50.
Yeah.
So that is what you add here to get the initial cash flow. It's clear?
Yes.
Then remember, depreciation is based on the historical cost bill.
Yeah.
So you can see depreciation here is cost of 2.4 year minus 500,000 divided by 5. So
Yeah.
every year it is losing 380,000.
Sure.
So the only now the terminal which we have here is this one, salvage value.
Yeah.
But if this is recovered towards the end, the 50, the net of 50.
In that question, were we told? Let me just check.
Bill,
Yes.
you see, investment in this asset is expected to cause increase in sale.
Yeah.
So it's like there is an increase. Once they buy this machine,
Yes.
the sales will increase, and then this working capital change will be realized
Yeah.
because there's a relationship between buying the machine
Yes.
and the change in working capital. So at the end of the year, then it must be realized because the sales will realize that net change. That is why it is being added here to get 550.
Okay.
Then now for the operating Operating, you just prepare the same table, bill,
Yes, as the one we made.
Yeah, sales, variable contribution, less fixed cost, then less provision for depreciation, a straight line of this, compute tax, add back provision for depreciation. You now get the operating cash flows every year.
Sure.
It's clear, Then this format here is just showing you from this point,
Yeah.
how you can deal with the savings. You see here we have earning before depreciation and tax.
Yeah.
250, 425, 530, 600, and 425.
Yeah.
So you multiply with this tax, multiply with the tax shield, you now be able to get the same answer here.
Yeah.
It's clear,
Yeah.
Which is now depreciation multiplied by the tax rate. It gives you 114 per annum for the 5 years.
Yeah.
It's now clear?
Yeah.
So if you multiply the earning times 0.7 and you add the tax shield of 114, you now get the same answer.
Sure.
Based on this formula here. So it's a short way. In an exam, you better follow this than this.
I better follow the second one.
Yeah, this is shorter. This is
Sure.
now what you're calling the tax shield. How much you will save from the depreciation. This is the annual depreciation per year. This is the tax rate. So every year you'll be saving 114,000 based on tax.
Yeah.
So now you just take this cash flow, multiply by 0.7, because it will give you the profit after tax. 0.7 is giving you profit after tax.
Yeah.
Then that profit after tax, you add the shield. You'll now be able to get this, which you determine the same year.
Yeah. Sure.
It's clear,
Yeah.
Then this is also related with what we have done in terms of incremental approach. What happens, for example, when you buy a new machine, you have an old machine, you buy a new one. So it's the same decision that you do in terms of, you have to prepare the same table and see, under machine 1, these are the cash flow. Under machine 2, these are the cash flow. Although there are some terminologies that we need to mention, and one of them is cannibalization.
Cannibalization.
Yes, cannibalization. This is it's like when you have two machines, you might find after investing in machine 2 is affecting with sales of the machine 1. It is like it is eating. Cannibalization, it's from the word cannibalism.
Oh, the one in agriculture.
Yes, so it's like the machine that you have acquired, it's like it is eating on your sales of machine 1 or project 1.
Yeah.
Then externality, these are just factors that are affecting the operations from outside. It is not based on the machine that you have invested.
Yeah.
For example, it could be affected by change in technology. That is externality. Then opportunity cost.
Yeah.
I'm sure you know what opportunity cost is. It's like if you don't invest in machine one,
Yeah.
there is that what you forego. That is what we mean by opportunity cost.
Yeah.
Then sunk cost is what you cannot be able to recover, what you have invested. It's like the initial capital investment.
Sure.
Then finally, Bill.
Yes.
Then finally, there is what we call capital rationing.
Yeah.
And this capital rationing is a concept which is emanating from scarcity of money.